February is where Chicago housing market show its real direction. And this month data showed the nuanced story. Prices dipped. Seller pushed the asking price higher, buyer negotiated harder, and transaction volume jumped sharply from the January numbers. At the same time, inventory is still down 17% compared to the last year. In today's update, I will break down what the spray tag war means, who has the leverage right now, where opportunity is forming, and how buyers, sellers, and investors should position themselves as we move into spring. So what changed in February? Pricing. Median seller's price for the closed transaction is down from 340 to 329. That's 3.3% drop month over month and 0.3% drop year over year. Original asking price is up 12% month over month, but it's 3.7% down year over year. Buyers on average paying are 96.9% of the asking price, which is about 0.5% less compared to the last year. Why it matters? Closed prices soften again, while asking prices jump sharply month over month. This diversion signals seller optimism returning faster than buyers' willingness to pay. This is a common early spring pattern, often leads to repricing or longer negotiations. Supply. New listings are up 59.2% month over month and 11% down year over year. Inventory is down 5.2% month over month and 17.1% year over year. Why it matters? Even with the surge of the new listings, total inventory continued to decline. This tells us that the demand absorbs new supply quickly and/or sellers remain cautious overall. Structurally, the market is still undersupplied compared to the last year. So how is the demand and the market pace? Number of transactions under contract went up 36% month over month, but 2.6% down year over year. Market time is at 61 days from 56 days month over month, but home selling 2 days faster compared to the last year. Why it matters? Demand rebounded strongly from January, but has not fully caught up to the last year numbers. Homes are taking longer to sell month over month, yet still moving faster than February of 2025. Another signal of market normalization, not weaknesses. For buyers, what changed? More new listings finally appearing. Sellers are asking more, buyers are paying less than the asking price. Why it matters? Buyers now have more choice and more negotiating leverage, but not unlimited power. Good homes still move, overpriced homes sit. So what to do next? Focus on listing with aggressive prices jump or longer days on the market. Use 96-97% list to close ratio as a leverage. Be ready to act as spring competition builds. This is one of the best balance moments buyers have seen in the months, but timing and discipline matters. For sellers, what changed? More competition entering the market. Buyers are negotiating harder. Inventory is shrinking overall. Why it matters? Sellers no longer controlling price outright. The market rewards realistic pricing and strong presentation, not optimism. What to do next? Avoid overpricing in response to seasonal momentum. Watch buyer behaviors, not headlines. Homes priced correctly still sell faster than the last year. You still have leverage, but only if you respect where buyers are pushing back. For investors, what changed? Transaction volume rebound, inventory tightened year over year, prices softened slightly, negotiation increased. Why it matters? This environment favors selective capital deployment, not aggressive expansion. Rental fundamentals remain supported by low inventory. So what to do next? Target motivated sellers reacting to slower absorption. Focus on assets with durable rental demand, not speculative appreciation. Prepare for more competition as a Q2 unfolds. February favored disciplined entry, not speed. The bottom line, February confirms the market is re-engaging, not overheating. Supply constraints remain real. Buyer leverage has improved, and strategy, not speed, determines the outcomes. Planning your next move? Let's connect.